Hello, guys, and thank you again for joining us at another episode, Pro Talk. Today, we're here with Sam, financial advisor. Before everything, you guys need to read the disclaimer on the screen and down below. Hi, Sam, and
Hello.
thank you for coming here today.
Yeah. I'm happy to be here.
Sam, this word of investing and financial is fast, like amazing word with so many different components.
Oh yeah.
I want to touch base on few of them that a lot of people probably have the same question I have is what is to invest in bond? What is it to invest in metals, gold? How do we do that? And how much money do we really need to invest in those things?
Yeah. So a bond, let's start with what a bond is. So what a bond is, it's just a debt obligation, or it's how a company raises money. So let's say you want to go buy a house, you go take a loan from a bank typically, and they loan you the money and you go purchase a house. Well, companies, they want to do similar stuff. Maybe they want to expand, maybe they want to pay off a higher loan higher interest loan they have. Whatever it may be, when companies want to raise money, a way they do that is by issuing bonds. So like Apple can issue a bond. And what that means is they're going to sell you essentially an obligation where you give them money, X amount of dollars, and they're going to pay you an interest rate in some time period. And then at the end of that bond period, or when the bond expires, they're going to pay your money back. That's a pretty quick and dirty way of what a bond is. And they're a great way. Generally, they're less volatile, so they don't move as much in price than stocks do. So they're generally seen as a safer investment than stocks because they don't move as much. But again, there's a bunch of caveats, and we could really dive into those different things. But it might be a more advanced discussion for a totally different episode because we can deep dive, and that's
Is it a low risk investment consider or is a high risk investment?
Well, it depends. A company like Apple, you want to buy Apple, and again, most companies are rated based on like Moody's has their ratings on companies as one example, and their rate companies like a AAA company, a AA company, an A company, B, C, and based on that rating, is it generally going to give you your risk level. So a company like Apple, who's a very sound company that's been around for a long time, they have a very strong balance sheet, a lot of assets, they make a lot of money, and they don't owe a lot of money. Again, so any investment is really a tool, and different tools can be used for different things. You wouldn't use a sledgehammer to put a nail in. Same thing with insurance. Insurance is a tool. It's a type of investment you could use, but it's not for everybody. Someone who maybe doesn't have a lot of money, they're super young, they don't have kids, they don't have any responsibility, doing insurance as an investment, cash value life insurance to be specific, may not be the best thing, but someone who's more established in their career, maybe they want some tax advantages. Insurance can be a great way to harness tax advantages.
How?
Well, that's it. How much time do you have? So with insurance, cash value insurance, you put money in you buy a permanent policy. Usually it's a whole life policy or an IUL, indexed universal life policy. And this policy lasts your entire life. So it's going to last as long as you make the payments on it, you'll still have it. You make a beneficiary, like give them a life insurance, you pass away. The beneficiary, maybe it's your kid, cousin, spouse, whoever, gets X amount of dollars. But with this amount of money, you could overfund it, which means that you put more money in the account than you need to pay off for the insurance costs. So you have what's called a cash balance. This cash balance can grow with maybe it's tied to an index to the stock market, maybe it's a whole life policy, so it grows at a fixed percentage, but it can grow. And what you can do is, while this money grows, in 10, 15 years later, you can actually access these funds to generate, you can touch these funds in the form of a loan. So you could take a loan out against your insurance policy. So let's say your cash value is $100,000. You could take a loan out for $100,000. It's tax free. Use it for whatever you want to.
You want to tell me right now, I can if I understand you correctly,
Mm-hmm.
I can go ahead and invest in this insurance
Mm-hmm.
or whatever insurance company that selling those,
Mm-hmm.
and later on I can tap this money like a bank account that I can touch it and get a loan against that money.
Yep, essentially, yeah. And it is a loan, so you will have to pay it back. You don't have to, and if you don't, all that happens is if you were to pass away, that amount of money that's outstanding would be deducted from the actual death benefit, if that makes sense. But certainly, yeah, it's very similar to like a Roth IRA account, which is an individual retirement account where you put money in, it goes in, it's taxable. So, but when that money stays in there, it's going to grow tax free, and you pull it out tax free with some, as long as you follow the rules. Same thing with cash value life insurance. You can get these policies, fund them, and 10, 15 years later, when you want to retire, maybe you want to take a vacation, buy an asset, whatever you want to do, you could pull that money out, and it's all tax free because it's a loan.
It's a loan. Wow. And
Yeah.
there is a minimum that you need to invest, or how that work?
It's going to depend on the situation. Typically, there are guidelines from the IRS of how much you can fund to a certain amount, and that amount, how much you can put into it, is based on the death benefit. But in terms of a minimum, it varies. It depends on your death benefit amount, but that's a conversation you want to have with a financial advisor because, like I said, cash value life insurance is a tool. There are other tools out there that are pretty similar to cash value life insurance that are more beneficial, like a Roth IRA, maybe a Roth 401k. There's other alternatives, but it's just a tool that's an add-on that you could use.
Sounds to me like a great tool.
Yeah, no, it's excellent. It's great, but this goes into more advanced financial planning. So you really want to sit down, but you don't want to just go buy cash value life insurance. Don't listen to the TikToks. Like don't go buy a policy just because you want to sit down with an advisor, look at your situation because like I said before, you're not going to build a deck with a sledgehammer.
That's actually great advice. All the talk on social media and about life insurance policy and how they take money out and how it's tax free.
It's great.
It's great, but like you say, you really need to sit down.
For a certain person, yeah.
One-on-one, let the financial advisor learn about you and then guide you what is the best way. Maybe it sounds great, but it's not all roses and flower.
Absolutely, and it tends to get a bad rap because it's sold by insurance agents usually, and sometimes you have bad apples in a bunch. It's not always the case, but they tend to get a bad rap. But they're again, it's a tool, and it can be a great tool, but it depends on you. So if you're a good fit for it, I highly encourage it. But if you're not, but you don't know unless you sit down, you look at yourself, you talk to an advisor.
I love that information.
Oh, yeah.
Sam, thank you so much. I hope to see you in the future in our channel again.
Yeah, no, I look forward to it. Thanks for having me.
Thank you.